something doesn't add up here. A company is growing insanely fast. Margins are already elite, and future growth is still strong. Yet the stock is dropping. That's the contradiction. Revenue up over 70%. Margins above 40%. Guidance still above 60% growth. And sentiment? Still weak. So what's going on? Because usually, numbers like that don't get ignored. And here's the thing. When performance is this strong, but price disagrees, you're not looking at a broken business. You're looking at a disconnect. What stands out to me is this feels less like a problem and more like something the market hasn't fully processed yet. Right now, investors are split, almost evenly. On one side, this is hype, artificial intelligence buzz, narrative-driven. On the other side, this is the future, a core player in enterprise artificial intelligence. But here's where it gets interesting. Both sides agree on something. The valuation feels stretched, too high, too demanding. After the rally, expectations became extreme. So now even strong results feel not enough. And that changes behavior. Because when expectations are that high, the stock doesn't need bad news to fall. Just not perfect. The way I see it, this tension is exactly where bigger shifts usually begin. To really understand this, you have to look at the past. Because this company wasn't always seen this way. For years, it carried a very specific label. Consulting heavy, government dependent, hard to scale, not clean software, messy, customized, slow to expand. And that narrative stuck. Even now, it's still there in the background. So investors keep asking, is this a real platform or just a high-margin contractor? That question hasn't disappeared. But this is where things start to shift. Because what's happening now doesn't fully match that old picture anymore. Here's where the story starts breaking. Quietly, United States commercial growth, up 137%. That's not small. That's a shift. Because that's private sector demand, not government. And then margins, over 40% operating, even higher adjusted. This surprised me, because normally, you don't get both. High growth kills margins. Margins kill growth. But here, they're happening together. And that changes the narrative. Because now the question flips. What if the old assumptions are outdated? To me, this is the first real signal that something deeper is changing. Now look at this, because this is where it gets uncomfortable. Revenue, $1.41 billion, up 70%. United States growth, 93%. Guidance, around $7.2 billion, growing over 60%. But here's the part that really stands out. Rule of 40? Gone. This is 127%. That's not normal. That's elite level efficiency. And yet, the stock isn't reacting the way you'd expect. Why? That's the real question. What this suggests to me is the market still doesn't fully trust these numbers yet. Let's break this down, because this is where it clicks. Growth is one thing, but profitable growth, that's different. 70% growth, with 40% margins. That creates leverage, real leverage. Every new dollar becomes more profitable, not less. And that's powerful, because now scaling doesn't dilute value. It compounds it. This is how elite software companies are built. Not as growth, but efficient growth. And honestly, this is where the story starts to feel very different. But here's what most people miss. This isn't just software. Not anymore. This is about deployment, real-world use. Most companies sell artificial intelligence tools. But this goes deeper. This is decision-making infrastructure, systems that actually run inside businesses, day to day. And that's harder to replace. Much harder. Because once you're integrated, you don't just switch. So while the market sees risk, what I'm seeing is stickiness. And that's a completely different advantage. Now the bullish side becomes clearer. Commercial growth accelerating. Margins already elite. Artificial intelligence demand rising. And guidance still strong. Over 60% growth ahead. That's not slowing. That's scaling. And sentiment starting to shift. Slowly. More analysts turning positive. More focus on execution. But here's the twist. Even with all that, the stock still struggles. Which tells you something important. The market isn't fully convinced yet. And in my opinion, That hesitation is where opportunity starts forming. But let's be real. There are risks here. Big ones. Valuation is still high. No way around it. This level needs perfection. Then there's geopolitics. Still a factor. And competition. Moving fast. New players. Simpler tools. Potentially cheaper solutions. So yes, this story isn't guaranteed. And that explains the volatility. The way I see it, the market isn't wrong to hesitate. It's just unsure which direction this goes. This is where everything comes together. The business is getting stronger, clearly, but the stock is being questioned. That gap is the turning point, not a breakout, not a collapse, a transition where the narrative starts changing, but price hasn't caught up yet. And these moments, they don't last forever. Eventually, alignment happens, one way or the other. What this suggests to me is we're right in the middle of that shift. So here's my view. I'm bullish, but with volatility. Short term, this will move around a lot, sentiment driven. But long term, this looks real, not just a story anymore. Execution, and that shift from narrative to numbers, that's where big opportunities usually start. Because once everyone believes it, the upside is already gone. Now it comes down to one thing. Can this continue? If growth holds and margins stay strong, this becomes dominant. If not, valuation compresses fast. So this is fragile, but also powerful because we're early. Enterprise artificial intelligence is just starting, and this company is already inside it, deep, which raises a bigger question. If this is the mature version of the story, what does the earlier stage version look like? Because the next one might be even more explosive.